Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. China refuses to hold talks with the US with American tariffs on imports worth $200 billion set to kick in a few hours from now. Indian regulators RBI and SEBI moved to assure credit markets, say they are ready to step in whenever required. SBI echoes similar sentiments. The banking regulator calls IL&FS shareholders LIC and SBI for a meeting this week. That is a Bloomberg Quint exclusive. And Tata Steel will buy Usha Martin's steel business for 4,300 to 4,700 crore rupees. In global news, Comcast outbids Fox and Disney to bag Sky for $30 billion. And that's some deal, isn't it? Anyways, let's see if there is a deal between the US and China. It doesn't seem to be the case. Tariffs set to kick in at about 12 a.m. Washington time, so in or about 3.5 hours from now. Is that having an impact on markets? Well, Friday, I think the markets closed reasonably well. So if you frankly look at what the US markets or the European markets did, because everybody thought that the trade fears were receding, they did reasonably okay. Dow was about 0.33%. In fact, FTSE, CAC, DAX, I think all of them ended with a fair bit of green. So the world markets are in a happy place, or not a sad place, let me put it that way, in Friday, at least the global markets. But of course, we all know what happened to our markets. And today, whatever is open in Asia might be open in the red. The SGX Nifty, of course, indicating that we'll start off marginally lower in trade, so about 0.5% or thereabouts. Hang Seng, you really can't give credence to it. A couple of other markets are shut for trade, so we don't have too many queues around the Asian region. But it'll be interesting to see once the tariffs kick in, if they do kick in, and once they kick in, what the impact is on those regional markets as well in tomorrow's session. So the world markets, iffy right now, SGX Nifty indicating a bit of a downside. Our markets were a different kettle of fish in Friday's session. A lot of pressure and a lot of volatility. In fact, if you just look at the open interest distribution and keep in mind its expiry week, that's the gyration that happened in our markets in Friday's session. And frankly, just look at the OI distribution on the call and the put side, and you would see that the highest concentration, of course, shifted down from 11,100 to 11,000 on the put side, and that remains a key level. Now, what happens if in the ensuing 4 days, we do have another day, which is like Friday, and volatility kicks in and we break those levels and stay below those levels, then that could exaggerate the pressures that are there at those levels. Some unwinding out there might just impact our markets too. The expiry week trades would, in all probability, mark up the options volatility. So brace yourself for that. At least that's the word that came in across trading notes that came out over the weekend on different publications. So let's wait and watch what happens there. There is some belief about broker margin call pressures to be triggered in specific stocks over the course of this week as well. I know a lot of people were attributing that to some stocks that fell in Friday's session too, but let's wait and watch what happens this week. Frankly, look at the usual suspects of Friday's session, the likes of Dewan Housing, Yes Bank, Indiabulls Real Estate, and there was chalk and cheese behavior there. Dewan Housing volumes at some 20 times the 5-day average, delivery percentage a mere 18%. Yes Bank, 10 times the 10-day average, and delivery percentage only about 23%. The relatively stronger Indiabulls Housing Finance and Indiabulls Real Estate is the mention out there. I was mentioning Indiabulls Housing Finance as well. The volumes for about 5 times the 10-day average, high percentage mark for delivery. So interesting chalk and cheese behavior between NBFCs as well. The interesting bit was, though, that the fund flows seemed positive. Both FIs and DIIs had some positive numbers that came in Friday's session. What to watch out for today, as our headline stated, $200 billion worth of Chinese products will be subject to tariffs from 12 a.m. Washington time. FOMC decision later this week. Most people expect a hike of 25 basis points, so brace yourself for that. And India fiscal deficit numbers, forex reserves, bank loan growth numbers, all of them will be released on Friday. So this is something to watch out for as well. In terms of stocks to watch, yes, I think Yes Bank and Dewan Housing would firmly remain in focus. I think both traders and investors would want to know what happens to these two names in today's session and over the course of this week as well. So these two remain firmly in focus. Tata Steel, they've announced the acquisition of steel business of Usha Martin, 4,300 to 4,700 odd crores. JPM says that the Usha Martin steel acquisition is at attractive valuations. It probably, to their mind, removes the overhang of them bidding for other assets with the values of which are not known. So they have termed it net positive for Tata Steel. Let's see what happens here. Usha Martin could be a stock that will focus as well. Bayer Crop, they are mulling to merge with Monsanto India. And ITD Cementation, they have received orders worth 845 crores from the government bodies. and this could be an interesting one to monitor too in the session today. However, let's try and figure out what we have on First Word today. We speak to Adrian Mowat about the possible impact of the fresh round of US tariffs that are set to kick in just a few hours from now. He joins us on the show from Hong Kong. Vishwanath Nair then joins in to talk about what's on the agenda of Reserve Bank of India and ILFS shareholder meet. And we dwell, of course, on the nervous credit markets and the regulators' assurance that they've got it under control. And last but not the least, it's back to basics for Bajaj Auto. Yatin Mota will tell us what's forced the two-wheeler giant to rethink its strategy. The US is just hours away from imposing a new round of tariffs on goods imported from China, with the Trump administration refusing to defer the plan. China has called off trade talks with the US officials. How do these escalating tensions impact emerging markets like India? Let's ask veteran emerging market equity strategist Adrian Mowat. He joins us from Hong Kong. Adrian, good morning. Thanks so much for joining in. Really appreciate you taking the time out. Now, this is a known devil. In all probability, $200 billion worth of tariffs kicking in, 12 a.m. Washington time, so in about 3 hours from now, our time. Do you think the markets are already prepared for that? Or could this throw open a fresh round of volatility for emerging markets?
I think you used a very good expression, this is a known devil. The markets in Asia and also US stocks that are impacted by trade wars have been hit since July. We have had this announcement coming through, and markets, if anything, have moved up a little bit. So I think we're probably coming to the end of the impact of trade wars on equity markets, insofar as there's been a fair amount of discounting of the tariffs. I think it's also important to sort of highlight that the tariffs don't seem to be impacting the electronics sector as much as people had feared. And in terms of market cap, that is very important in Asia, particularly in Korea and in Taiwan.
Interesting. So are you saying, Adrian, that if these, I mean, let's work with the presumption that these tariffs kick in, there are no negotiations from either of the sides, and at some point of time, China would retaliate in some shape or form as well. This will not have a meaningful impact. I've heard various figures about people saying that even if the tariffs kick in and there is an impact on the US markets too, as a percentage of GDP, it's a negligible impact, and therefore the equity markets may be making too much of it, but maybe it will not be as drastic an impact. Are you on that side as well?
Well, I think firstly, there's a lot of different things to sort of reflect on with what you just asked. I would highlight that the world economy is moving more towards free trade than against free trade. Now, why do I make that statement? If you look at the European community, it's signed free trade agreements with Japan. It's signed free trade agreements with Mexico and Canada, as well as Australasia. Within Asia, yes, the United States has left the Trans-Pacific Partnership, but other Asian countries are moving ahead with that. And so if we look at this on a trade or GDP weighted basis, we're actually moving more towards free trade. Now, there are specific industries and companies that are impacted by these tariffs. And I think the share price movements since July have been reflecting that. So I would put sort of two ideas forward here. One is that the market has quite clinically analyzed the situation, and it has been reflected in stocks that are more impacted. Secondly, I think we might be overemphasizing the trade dispute on a global context. If you look at what's been happening with negotiations with Europe, including through to sign deals. The other thing I'd also like to highlight that economies tend to be much more about domestic consumption and investment. That is also true of China. I mean, one mistake we made back in the 1970s and 80s was we overemphasized the importance of trade for the Japanese economy rather than the importance of the domestic economy. The signals that we're getting out of China is that despite a considerable slowdown, actually contraction in shadow banking finance, despite a strong focus on the environment and reducing energy use, the Chinese economy continues to track at quite a healthy pace. So long answer, but I think the markets have already discounted the story.
Adrian, the other question is the whole conversation for the last 12 to 18 months around how the global growth and the global GDP is moving up because of, well, one, coordinated policy action, yes, but two, trade across the world stepping up, and therefore the GDP print on a lot of large economies has been looking reasonably okay than what it was in the preceding 3 years. Does that get threatened at all, or would you reckon that one, the GDP numbers will look okay, and therefore the markets will take those as your stride as well, if this were to escalate further?
Yes, so look, I think there are negative implications of this trade war. And you have seen quite a lot of economists shaving a few basis points off growth rates, including in places like China. There will be some impact on business sentiment as they are uncertain to go ahead with investment decisions because of these tariffs. It may, in some countries, generate some benefit if it's deemed that investing out with China is a better course of action. But I think at the margin it'll have some negative effect, but it'll be much more marginal. And I think the normal domestic cyclical cycles will probably be more important.
Okay, Adrian, my final question really is on India. Now, we had some domestic factors as well which have impacted our markets. What's your sense of how does India shape up in a scenario like this? Trade wars, Fed taper, rate hikes, and steep valuations, but the micro looking strong.
Yes, so I think we acknowledge that the macro is looking reasonably strong in India. We have an equity market in India that an index level has performed extremely well relative to other emerging markets. Although when we drill down to the details of that, one could argue that it's been a slightly more defensive and export-orientated bias to the outperformance. I think the cyclical dynamic to look for in India as we go into 2019 is how much do inflationary pressures build. The Indian consumer is extremely cost-conscious. It tends to take a bit of time before you can pass through increased costs. And with the rupee where it is, combined with the oil price, there clearly are higher costs. And you can see that in some of the damage that's being done to the profitability of industries like airlines. So next year, I think the cyclical story for India is really going to be all around inflation and RBI policy. And I think that is probably a more challenging environment than we've seen in 2018. Now, with regards to the Fed's raising rates, ultimately this is a sign of good news in that the US economy is strong, unemployment rate is low, and you're getting a normalization of monetary policy. That said, it is generating a strong dollar, and it's generating a strong dollar against a backdrop of some very specific emerging market stress. So we would highlight South Africa moving into recession, the stress we're seeing around Turkey, not an emerging market, a frontier market, but a place like Argentina does tend to dominate the headlines. We've also got political issues to consider in places like Brazil. And I think when you get the combination of the Fed raising rates plus these specific EM issues, the asset class is very much out of favor. And what happens with India is that India suffers from some of the redemption selling that you see in passive products. And the rupee also suffers in that environment, in that India still runs, albeit a modest current account deficit. It is a current account deficit. So I think India definitely fits in with that. Trade wars, I would to some extent say that India is relatively isolated from trade wars. So far, Trump's trade rhetoric has been very much focused on goods as opposed to services, which would impact the Indian IT space. So I think you dominate your discussions and your strategy in thinking about the domestic cyclical for India next year. Okay. And then the other factors probably tell you a little bit more about timing and why you might continue to see some pressure in terms of FII selling.
Interesting, but a lot more sanguine Adrian Mowat than what I would have presumed. Adrian, good having you. Thank you so much for taking the time out and joining us and giving us your perspective. Well, tariffs may kick in. Adrian Mowat doesn't believe that will have a meaningful impact on markets by and large, definitely not on India. Speaking of India, the Reserve Bank of India will step in and take stock of one big situation that has been unfolding and impacting markets by and large, and that's ILFS. Sources tell Bloomberg Quint, the regulator, has called for a meeting with the shareholders on September 28th. This, as a group, continues to default on its debt obligations. Vishwanath Nair, who's been tracking this all through, joins us with the exclusive and maybe more. Vishwanath, what have you picked up from your sources?
So over the weekend, some of the bankers who are involved with ILFS, who are shareholders of ILFS, they got to know that the Reserve Bank of India is calling for a meeting on the 28th of September. This is essentially to take stock of the situation. Remember that the Reserve Bank has already started something known as a special audit that was earlier this month, and that was Bloomberg Quint had reported this. This was after ILFS failed to repay the intercorporate deposit to SIDBI. SIDBI went to the RBI, and the RBI initiated the special audit. This meeting now is right ahead of the crucial AGM that is going to happen on the 29th of September. At that AGM, the shareholders will be voting on whether they will be participating in the rights issue, about 4,500 crore worth of rights issue that is going to take place at ILFS, as well as LIC and SBI, whether they will be willing to extend a 3,500 crore loan to the company. So both these votes will be taken care of on the 29th of September. So this meeting that the regulator is holding is to get a sense of how big the stress is in the company, and secondly, what the shareholders intend to do. Now, remember that just on Friday, ILFS Financial Services, the NBFC arm of the ILFS group, they said that they have defaulted on a few credit obligations to IDBI Bank. They've also said that Ramesh Bawa, the CEO of the company, has resigned with immediate effect, and they elevated the CFO to oversee the company's processes. Also, ILFS and a number of its group companies are already in the middle of an asset monetization plan. We understand through SBI Capital, and they responded to an email that we sent out, that they have already shortlisted about 10 operating projects for sale, and that they have also been called in to sell majority stake in the ILFS Financial Services, the NBFC arm at all. So, a bunch of things moving at the same time, but the Reserve Bank's meeting is crucial because it's important to know what the status is and what the regulator can do. Remember, on Sunday, the regulator also put out a statement along with SEBI saying that it is closely watching all market developments and it is willing to step in whenever required. So,
yeah, all of that. So the MD and CEO is Ramesh Bawa has quit. There's a meeting for shareholders that's our exclusive, and the asset monetization plan. And I think Bloomberg, Vishy put out a note saying that they have scanned the internal memo, and according to them, I think they've received investor interest for 14 assets out of the 25 that it put on the block.
That's right. That's right.
Wow.
So interesting times for ILFS, and closing all of this within a very short time frame would be very important for the company, because unless there is some infusion on an immediate basis, there are a bunch of credit obligations that are going to come up for repayment in the next few months, and they won't be able to pay it if the infusion doesn't come in on time.
Well, let's hope it does come about, because it's not just impacting ILFS as we've now seen, but a bunch of other asset classes, including mutual funds, by the way. Vishy, thanks for putting this into perspective.
Thanks,
really appreciate your time. So that's the Bloomberg Quint exclusive, really. RBI has called for a meeting with ILFS shareholders very, very shortly. I think the story is on the website as well. And if you read that, you'll get to know that one of the deputy governors of Reserve Bank of India will attend that meeting. So meanwhile, while all of this is happening, just a very quick recap of what is happening around this whole NBFC space from a market's perspective. Now, scanning through all the notes that have come out over the weekend, I think 2 or 3 things. There are some concerns over tightness in money markets because of this continuous or continuing financial crisis at ILFS. Remember, there is no crisis, but there is maybe some tightness around the money markets, and if DSP had to sell off that bond at a slightly higher coupon than what was earlier existing, that gives you an indication of the tightness that exists in some of those corporate bond markets as well. There are beliefs that select NBFCs may find it tough to roll over some of their short-term positions. Again, just beliefs, mind you, nothing given or sacrosanct, and there's a well, talk of, I mean, not really talk, but a calculation that NIMs of select NBFCs will be compressed if indeed fundraising has to happen at a higher price than, or a higher coupon than what the current positions would be, and that would happen at some point of time. Just a natural state, really, cost of funds moving up, and some of the NBFCs might find the pinch on their NIMs as well. Typically, I think CNSA put out this very interesting note, and in that graph they're saying that spreads for some of the smaller NBFCs tend to move up much quicker. The one-year corporate bond, AAA, the spread widening from September 17 to September 18, not that high compared to BBB or even in A, because there the spread widening happens at a much faster pace. So the NIMs for some of these NBFCs will get compressed coming ahead. We've already done a recap of all that's happened in IL&FS Financial Services, so I won't dwell too much on it. But for the fact that that company remains firmly in news, and whatever happens out there could have a bearing on the NBFC space and the money markets as well. Speaking of the regulator, and I think a lot of talk over the weekend about why is it that the regulators and the bodies are not coming out and giving some statements. Both the RBI and SEBI last evening came out with joint statements. They've said that they are monitoring recent developments in the financial markets and they are ready to take appropriate actions if necessary. In fact, the SBI chairman came out with this clarification saying that some comments are being attributed to State Bank of India. I'm quoting this. Some comments are being attributed to State Bank of India about the bank being wary of lending to NBFCs. The rumors are baseless. SBI lends support to NBFCs in private and public sector within the regulatory policy framework and will continue to do so. In fact, the recent regulatory guidelines on the company lending model opens up further opportunities for collaboration between SBI as well as non-deposit taking NBFCs to increase lending to the priority sector. There is no concern on liquidity of NBFCs in view of their highly liquid cash positions and availability of committed lines. So this is as strong a clarification that comes in from the largest bank in the country. No liquidity concerns, definitely not a crisis situation. So let's not try and spread things around that. Do you make use of this crisis? That depends on each individual, because both in Friday's session as well as the last 1 month, some of the stocks have really gotten pummeled. This is Friday's performance, and look at that. From the highest quality names to some of the mid-sized names, Bajaj Finance, Edelweiss, Canfin Homes, Repco Home, across the board. It was not just restricted to housing finance companies. Across the board, we saw NBFCs come off, and that's been the trend really the last 1 month. Look at that. Edelweiss, ILFL Holdings, L&T Finance Holdings, M&M Financial. The least that these stocks have fallen is about 15%, with the losses going as high as over 20% as well. So it's been a bad Friday, it's been a bad month, and the reasons, of course, something that we discussed. Okay, the last piece on First Word today is on Bajaj Auto. They've recently made headlines when it said that they're looking to turn back focus on the entry-level segment. The Pune-based two-wheeler maker, which made a conscious decision to stop making scooters, has probably been tempted to change course after the Pulsar and the Discovery failed to hold on to the market share in the respective segments. Yatin Mota is here to tell us exactly what's not clicked for Bajaj Auto and what could be the course ahead. Now, Yatin, is Rajiv Bajaj earlier said that he was willing to sacrifice volumes for margins. Has that turned around?
Well, from the not from the management perspective, but clearly from the financial perspective, we have seen in the last few quarters the margins are under pressure. Now, if you look at the first chart, which we are talking about, is the kind of margin picture on the EBITDA level, which have changed in the last few quarters. And look at this, they were comfortably doing 20 plus kind of a margin trajectory since last FY16. And these are the quarterly margin run rates which we have noted down from the Bloomberg. Now, what happened is that from 21-22% post the GST came into place, we had the margins which fell. Of course, this was largely to do with dealer compensation and the GST disruption. They bounced back from there. And of course, in the last 3-4 quarters, we have seen the margins clearly under pressure on the domestic side. The overall margin 17.6% for the first quarter FY19, and that clearly surprised the analysts. The stock was under pressure. What's really changing, this margin trajectory for Bajaj Auto is the clear focus on the entry-level segment or the commuter segment. Now, if you look at the market share also in the motorcycle segment in the last 5 financial years, and we have taken the last 5 financial year data, which is easy to digest. Bajaj Auto was standing tall at 20% market share, but clearly the strategy for Discover failed. They launched multiple Discover model post which they started losing market share and ground in the domestic motorcycle market, and today they only stand at 16% of the total motorcycle volumes. Surprisingly, Neeraj, most of the top 3-4 players, including Bajaj Auto, have maintained the market share. But Bajaj Auto is the one which has ceded market share. So if you look at Hero MotoCorp, they have been more or less stable above that 50% mark. We have Honda, we have TVS Motors, which have more or less maintained their market share. In fact, Honda has gained the market share because of the scooter segment and the motorcycle segment. But Bajaj Auto is one of those players which has clearly seen some pressure on the market share size. Of course, in order to address that, the management recently cut the prices of CT100, which is the entry-level motorcycle. They on various platforms said that they are making EBITDA losses as far as the CT100 is concerned in terms of the profitability. And clearly, in order to gain market share, somewhere or the other, they have been now starting to compromise on the margin picture. If you look at the next slide, which talks about the changing product mix. So as I was telling earlier, they are now looking to gain on the commuter segment side. So if you look at the domestic data points, from 22% in terms of the product mix, the share of commuter segment for Bajaj Auto is now 56%. So that is a kind of change that we have seen in the last 5 financial years, that the entry-level segment where Hero MotoCorp is the market leader, Bajaj Auto has been trying to focus. Their entire market share and the overall product mix has changed significantly. And if you look at the executive segment, which was bulk of their sales share, from 47%, that has come down to 4%. However, the premium segment is now more or less stable for the last 4-5 financial years at 40%. But clearly, as I was mentioning, the commuter segment is something which is of Hero Motors' forte. Bajaj Auto has to clearly make the changes in prices in order to generate that demand, and you can clearly see that how the product mix is changing for Bajaj Auto. Slightly adverse, it's an adverse kind of a product mix according to analysts, but clearly let's see how Bajaj tackles this change in product mix in terms of the delivery on the financial performance and the EBITDA margin front.
So there seems to be a problem of plenty for Bajaj Auto as well, Yatin. I mean, as far as its other segments go.
Yeah, so in 2013 they launched a series of products, including the Discover, and in the Discover they had a lot of variants coming up in order to address the consumer needs. Of course, that was misjudged, and that strategy backfired. That not only cannibalized the products for Bajaj Auto, but also it led to loss of market share. Of course, for Bajaj they have Platina, Discover, Platina 125 in the entry side, and we have CT100 also. For Hero MotoCorp, we have CD Dawn and CD Dawn DLX, which have been doing fairly well despite the kind of price changes that we have seen in the marketplace. Now, this is what I was talking about. This clearly, according to analysts, confused the consumers. Look at the kind of variants that they had for the Discover series, from 100cc to 125cc 4.5 variants and 150cc also. So this kind of a product strategy clearly backfired for Bajaj Auto in the last 3-4 years. Of course, they went back and had a big withdrawal as far as the Discover segment was concerned. But look at Hero MotoCorp. They have kept the product portfolio quite simple and quite low. Only 3-4 models to choose from, and Splendor, of course, has been doing well for them. Passion Plus, Glamour, these were the models from where Hero MotoCorp was able to defend their market share from Bajaj Auto. And similar is the case with the premium segment, wherein they have this kind of product. KTM is something, of course, which Bajaj Auto is betting on a global scale in order to get that premium segment market share moving up. Of course, for Hero MotoCorp, that is one segment which is not really a big contributor in terms of volumes as well as from the margins. But if you look at the interesting segment, what Bajaj Auto missed was the competition to Bullet. If you look at the Bullet sales from FY14 to FY18, they were starting at a number of 2 lakh units, which they reached to a peak sales of 8 lakh units. Of course, this is the Q1 data, but they have been able to quadruple the Royal Enfield sales, whereas Rajiv Bajaj on record said that they will be looking at 2 lakh units for Dominar, as a big game changer for them. They went all out in terms of market advertisements and market strategies. But look at this, the Dominar is only selling 5,000 units in the first quarter, whereas Enfield sells nearly 3 lakh units in the first quarter. We also have the FY17 and FY18 data, which is hardly 10,000-15,000 units, clearly stating that Enfield has been able to gain ground. Come what may in the domestic market, Enfield rules, that premium biking segment, which is 200 to 50 cc. And the last one, which is the scooter market, which has grown significantly from 21% of the two-wheeler market. 1/3 sales now come in from the scooter segment, and Bajaj Auto is clearly not present in the segment, which has clearly hurt their overall sales domination in the domestic market. We have the motorcycle contribution from 73% of total industry sales come down to 64%. Of course, bulk of that has gone into the scooter segment. However, mopeds are coming down as a product category. So clearly, scooters is something which Bajaj Auto missed. Of course, it is well documented, but this is something which the viewers would understand, that now scooters are nearly 1/3 of the total sales. So every third bike is a scooter which is sold in India.
Wow. Multiple things that have not worked for Bajaj Auto. Let's see if a change of strategy does work around. Latin, thanks for putting that into perspective. Well, that's an exhaustive piece on what's worked and not worked for Bajaj Auto, but that's all that we have on First Word today. Lots more lined up on Indian Open. We discussed the panic in the markets over liquidity with NBFCs, with Mahendra Kumar Jaju of Mirae Asset Global Investments and Lakshmi Iyer of Kotak AMC. And of course, what does the country's largest NBFC make of these credit concerns? A conversation with KK Mistry of HDFC. But after this break, we tilt towards the day's trade.
Good news, got a promotion and a damn good raise.
Congrats बेटा।
वाह, रेज अब तो इंश्योरेंस पॉलिसी ले ले।
कौन सी कंपनी से लूं?
चूज वही जिस पर हो पूरा भरोसा।
That's good, but आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना, same choice. LIC.
LIC trending with times. 62 सालों से हर generation की पसंद।
When I started juicing to bounce back from a serious injury, I had no idea that it would turn into a passion, that would turn into a brand that provides healthy choices to millions of consumers. Today, my brand is a household name. I am Anuj Rakhian, and my story is a clean and a flavorful one. I'm the raw pressery guy, and I'm here to tell you my story only on Aegon's of Business.
Aegon's of Business never stop. Only on Bloomberg Quint.
I want to talk about how disruptions are coming and how we'll have to weave that into our portfolio, into our investment thesis. Because clearly in this whole world of disruption, there will be few winners, but those winners will make tremendous amount of wealth.
Hi, this is Safir Anand. I'm an investor and I look forward to interacting and speaking at the Investor Carnival 2018 in Goa exclusively for Bloomberg Quint.
Hello and welcome. You're watching Indian Open right here on Bloomberg Quint. An exciting start to the week after the truncated week that we've come out from. A quick look at what's happening across Asia. There are a few markets which are shut for trade today, but Hang Seng is trading, and that's trading under by about almost 1.5%. So some deep gashes coming in there. SGX also pointing towards a lower start. Closer to about 0.25% is given up by the SGX Nifty. 11,145 is where we are currently trading at. Friday's session was, carnage towards the end of trade. The second half of trade, the gap just widened in terms of the bears taking grip of the market. But what happened on the futures and options side? Agam is joining in to talk us through that. Agam, good morning.
Good morning, Devina. Well, the picture has completely changed last week, given we are heading into expiry. So we are looking at a substantial amount of changes with respect to the kind of levels that we're keeping an eye on. Well, that said, we are currently at around 11,100, and the Nifty has, seen substantial amount of weakness, and we have started to see, unwinding coming along when it comes to the September series, and more towards short side when it comes to subsequent series. And of course, when it comes to the Nifty banking futures, shorts in the September series themselves. Do remember the Nifty rollovers currently stand at 10%. Because this expiry, we'll start to see a pickup in rollovers coming through as well. The India VIX has advanced by 11% at around 15.5. Can this come off? Let's wait and watch. Excuse me. But when it comes to open interest and changes in open interest, it was the 11,200 mark which was the most active, considering we saw a little more writing around the 11,200 call, and unwinding naturally, considering the Nifty came off to a certain extent at around the 11,200 put. That said, let's take a look at some of the stocks then. And okay, of course, the put call ratio surprisingly remained unchanged at 1.14, despite the fact that we did see the Nifty come off to a certain extent. But Adani Power, that moves into the band, and Balrampur Chini, on the other hand, moves out of the band, which declined by around nearly 10%. Yes Bank, of course, we can't not talk about this one, considering the substantial weakness that we saw. Declined by nearly 30%. We have seen shorts across all series. And Dewan Housing, on the other hand, which dropped by as much as 43% in the mid-cap space, is where we have seen unwinding, not only in the September series, but also in the following series coming through. And finally, Just Dial, one of the few stocks that actually bucked the trend, advanced, and we're starting to see a little bit of longs building in. But all eyes will remain on the financials, which was substantially weak last Friday, and we're going to have to wait and watch whether or not we do see a little more recovery, or can we expect more weakness coming through.
All right, thanks a lot for that. That's the futures and options action that unwound on Friday's session. Remember, this is expiry week, so a lot more action expected. But let's quickly bring on board Avinash Gorakhshekar. He's the head of research at Joindre Capital. He's here with us on the show. Avinash, what a disaster on Friday in terms of the kind of peripheral damage that was caused.
Yeah, I think clearly, the markets were completely rattled and completely surprised, considering the fact that almost every housing finance company was battered quite significantly. I think, Devina, today our sense is that looking at the kind of clarifications, Dewan Housing and Indiabulls Housing has put up, we could see some sort of recovery. In fact, our sense is that we could get some more headline numbers and commentary on the analyst meet, which Dewan Housing is having at around 10 a.m. today. Our sense is that, clearly on terms of the asset quality, asset liability mismatch, there doesn't seem to be a large kind of number. And I think the markets would obviously get some sort of, comfort, hopefully, as time goes. But clearly, I think the way the NBFCs were hammered, I would not be surprised that there could be a bounce both in Indiabulls, Dewan Housing and the other well-managed NBFC companies, although there remains a concern that interest rates going up would definitely now eat into their margins.
That's the headline concern, yes, but I think what happened with Dewan smacks of something more than just pure fundamental reasons because of which the stock was sold off. I mean, the stock wouldn't fall 53% because somebody at one point of time thought that there is some issue out there. So a lot of rumor mills doing the rounds, frankly. Let's not get into all of that. Avinash, though, what about Yes Bank individually?
No, I think...
my question is, would you use this fall to buy it, or is it a bit of an unknown because we don't know what will happen eventually come January?
No, I think clearly, Neeraj, clearly, till the time the new CEO comes in, you are not going to see run up, quickly. But I think on a fundamental basis, I would definitely look at buying the stock at this price. Maybe we could see a little bit more correction, as market factors in some concerns about the RBI number on the, asset quality concerns. But I think overall, if you look at the kind of advanced tax numbers which Yes Bank has paid and the kind of CASA as well as the geographical reach the bank has got, I think this is a great opportunity for people actually, for investors to actually build a long-term portfolio. I think Yes Bank definitely is one of those aggressive private sector banks which could definitely be accumulated, provided one has a slightly long-term window here.
All right, that's Yes Bank, and according to Avinash, you can put it in your long-term portfolio. 226 on the counter, beaten down by 40% this month. But another pocket to look at is going to be the dairy pocket. The government has increased export incentive on milk and certain milk products to 20% from 10% earlier on. This export incentive will apply for 4 months up until January next year. Now, the dairy industry has been seeking for support from the government for quite some time, with raw milk prices staying stagnant for some time now. So will this move help the industry and to shore up prices? Let's ask the management at Prabhat Dairy. He's joining us right now, the Joint Managing Director, Vivek Nirmal. Thanks very much, Mr. Nirmal, for joining in. Is this something that the industry was seeking for a really long time, and what did you make out of it?
So this is definitely a very welcome move, and industry has been looking at soft, particularly that the commodity which has been manufactured in India has to move out. In last 2 years, there have been a good rate of increase in milk production, but due to the global bearish markets, the milk powders and butter and other stuff have not been able to move out, thereby putting a pressure on the indigenous milk prices. But I think this is a very welcome move. The MEI scheme, which is around 10% now, has been moved to 20%. Although it is not on all dairy products like butter or butter oil and all. It could have been better if these two products were added, but it is now there on milk powder. So this will definitely help the stocks in India to move out. The dollar also now is actually helping for exports. And if the product this moves out, this will be good for the industry for the year to come.
What does it do to prices in these individual categories that you just mentioned?
In the international market?
Yeah.
In the international market, see, the skim milk powder prices are in the range of around $2,000 per ton, $1,900 to $2,000 per ton. And with this 20% export incentive and a favorable dollar, I think it will at least come to the parity for the Indian ingredients manufacturer or commodity manufacturers, particularly for export.
Vivek, good morning, Neeraj here. But would this be would this lead to an impact on the domestic prices as well? I was speaking to Chandramohan of Hudson Agro, and he was saying that the domestic prices are terribly depressed because of no export. If this happens, do the domestic prices move up?
Yes, see, in terms of, if you see the consumer prices, the MRPs and will not move up even after this, because there is a lot of stock, and that's why the prices are depressed. I would say that the prices will not depress further, because the stocks will move out. But I don't see a lot of chance for the domestic prices to come up due to this. In terms of the retail prices, yes, in terms of the commodities, the prices which have come down will definitely come up by 10-15%, because a lot of stocks will move out.
What is the kind of supply glut you're talking about right now in terms of the demand-supply mismatch?
See, there has been a continual milk production increase in last many years, and okay, in I think 15, 16 and all, there was a drought-like situation, but in 16, 17, 18, monsoons have been pretty good, and milk production has increased. But on the contrary, demand, if we see in India for dairy products, has been increasing, but it is not to the pace of the production increase. And normally in such times, a lot of stocks move out. That is what has happened historically. Always this has happened. But incidentally, this time, the stocks in last 2 years have not moved out to the tune which they had to move out. And hence, because of the depressed international markets. And hence, a lot of stock has stayed in India. A lot of dairy cooperatives have huge stock piles. And that is what is depressing the raw milk price. So this has actually caused a glut. With this stock moving out, with this ops what state governments are offering and the central government are offering, the position I think would come back to normal.
All right, Mr. Nirmal, thanks very much for joining in and clarifying that for us. So probably may not do much for domestic MRPs on these products, but internationally it is a favorable move in terms of international prices.
Interesting. Avinash, any thoughts here? Dairy companies?
Yeah, I think clearly, if you look at most of the dairy players which have got a well-branded kind of presence, something like a Parag Milk or Prabhat Dairy, I think some amount of incentives on the export market would definitely help them. But largely, Neeraj, this is a domestic market. I think very few companies have a large export exposure. So, nevertheless, this definitely is earnings positive, but the impact of this on the earnings would take some time. So, I think it's definitely positive, but longer term, I think these benefits would come in. Maybe in the short term, this benefit is not going to trickle down in immediate earnings numbers.
Okay, no immediate benefits, maybe long-term benefits. I think that's pretty much what Vivek Nirmal mentioned as well. But lots more happening in the markets beyond ILFS, Dairy and Yes Bank and DHFL. Let's get in our research team in the research huddle to talk about all the key newsmakers and movers. Nikki, Shraddha as well as Agam here to dissect them. All three of you, good morning. Thanks for joining in. To the big newsmaker of the day first, and Tata Steel and Usha Martin, the impact on these companies and what is the news?
Neeraj, the capacity is really very small, and in terms of contribution also, it's going to be a 2% addition to the EBITDA. But then the main point that they're highlighting, most of the brokerages are highlighting that the overhang on now Bhushan Power and Steel, the Tata Steel now going ahead and aggressively pursuing the company, that comes down. So that's something that is key takeaway, and it will not, the balance sheet situation seems to be a little, the concerns have been allayed. Basics, they've signed the pact to acquire Usha Martin for a consideration of around 4,300 to 4,700 crore. The deal is expected to be completed in 6 to 9 months. The acquisition is expected to be completed in 6 to 9 months. It's subject to CCI approval, government and regulatory authorities. And with this, overall, Tata Steel acquires 6.5 kind of capacity through the acquisition of both Bhushan Power as well as the company. It's a 1 MTPA capacity that we're talking about. What Usha Martin brings on table is the 1 MTPA capacity, coal mine, captive power plants. And if you look at the sum that Tata Steel will have to shell out, will be less than a quarter EBITDA. It's like a 5,000 odd crore that the company did in Q1 FY19. The deal valuation is somewhere around 4,300, 4,700 crore. JP Morgan says it maintains the overweight rating, says the target price of 980, which indicates a potential upside of more than 50% on this counter, says valuation at 7 times is attractive. The acquisition has been done at the right time and removed the Bhushan Power overhang. Macquarie on Tata Steel importantly highlights that this deal is just going to add a 2% to Tata Steel EBITDA, 5% to Tata Steel net debt, and around 1% EPS accretive for FY20.
Nikki, thanks a lot for that. By the way, just before I get to Shraddha, remember over the weekend, SEBI, RBI, both of them put out their assurances to the credit markets. Now, FM Jaitley has come out with clarification. I think the tweets are there on your screen as well. It's saying that there will be adequate support being given to NBFCs if there is a need. So, all the powers coming out in a coordinated fashion to assure the credit markets that there is no reason to panic. And I think this is important as well, because on Friday almost everybody was talking about why is it that we're not getting any assurances. So RBI, SEBI, SBI and now the finance minister have done their bit, at least in trying to assure the markets that there's no reason to panic. However, panic we did in Friday's session. What about some of the other stocks, Shraddha, aside of Tata Steel and Usha Martin? What are the other stocks?
Neeraj, Biocon is another one. Two positive developments for this one. One is that the US FDA has completed inspection at its Bangalore facility and they haven't issued any Form 483. Secondly, for Mylan and Biocon partners, now European Medicine Agency's committee has recommended approval of its biosimilar product Pulfulia. This will now, this positive opinion will be considered by the European Commission, the decision for which will be out by November 2018, but at least positive recommendation coming from the committee, so positive development. ITC Cementation is another one. They've received orders worth 845 crores. McLeod Russell continues to sell tea estates, another two being sold for 180 crores. And according to a ET report, Inox Leisure has terminated a contract with Book My Show, which is the country's biggest online ticketing platform. outperform. This is because of disagreement over payments. Let's see if there has a little negative development for the stocks. And Sequence Scientific, they will acquire the API facility of Solara Active Pharma at Mahad. This is for an enterprise value of 46 crores. And finally, Elpro International, where the promoter has been adding to its stake in the month of September. As according to Insider Trades, as reported on September 20th, the promoter has picked up 0.27% stake. Earlier, they had picked up 0.3% stake each on 12th September and 17th September. So at least somewhere where the promoter is picking up stake.
Well, let's see what some of these stocks could react as well. Just quick thoughts, Agam, on I think Marico, right? There is a Credit Suisse note.
Right. So it's maintained and outperform, and it put a price target of around 405. I think the key point they're making here is the copra prices, the fact that they've come off from about 145 rupees per kg in January to about 100 rupees per kg currently. And that's one of the main reasons behind them remaining positive. Of course, they're also expecting a growth of around 8 to 10%. That's according to the management when it comes to the volumes. Good cues coming in from your value-added hair oils as well as Parachute. But Saffola perhaps remains in a challenging spot, but on the whole, they're positive when it comes to Marico.
Well, copra prices and a lot of other factors. Agam, thanks for putting that into perspective as well. So that's a lot of stocks which are in news today. Avinash, quick thoughts on Tata Steel / Usha Martin?
Now, I think it definitely seems to be a good acquisition, Neeraj, considering that this capacity is fairly large, 1 million tons, and I think along with that they get a lot of specialized alloy steel capacity, a captive iron ore, a captive coal mine. So I think all in all, definitely it's a good acquisition. But in the downside, at least in the near term, the markets would be worried at the kind of debt funding, because clearly this is going to be funded by debt. And looking at the current debt of Tata Steel, probably in the next 2 to 3 quarters, we could see elevated interest costs. So I think clearly, in terms of the longer term benefits, I think a good augmentation to the steel capacity for Tata Steel. And I think longer term, one could expect a better, kind of incremental addition to the EBITDA as well as the top line for the company, say, from FY20 onwards. So I think in the near term, there could be some interest cost pressure, but overall long term positive.
Long-term positive on that one. Tata Steel there is the stock in focus. Let's bring in our technical experts as well. So Ruchit Jain, technical analyst at Angel Broking, he's joining us on the show right now. Ruchit, before we talk about anything else, let's quickly run through what your index strategy is going to be at these current levels.
Hi, very good morning everyone. Certainly since this calendar month, we have seen that the Nifty has been forming this low top, low bottom structure on the daily chart. And on the earlier also, a couple of weeks back, we spoke how the Nifty, although had made a new fresh high during last month, but somewhere the mid caps and the small cap indices were lagging behind. And I think this corrective structure is clearly an impulsive down move, so which is an indication that till this low top, low bottom structure on the daily chart is continuing, the short term trend would continue to remain down. Now, generally, when such structures are formed, the swing highs are where the stop losses are kept on the short positions. So 11,350 is the new swing high for the Nifty index on the daily or the hourly chart. So the stop losses on existing short positions, if any, should be kept above 11,350. On any pullback moves around 11,210 should be used to create fresh short positions. So this is a sell on rise kind of market for short-term traders. 11,210 is where the first resistance is. So go short whenever the market gives a minor bounce back around 11,210, keeping stop loss above 11,350.
All right, we'll come back and discuss your individual stock strategies. But before that, it's time now to get onto our special segment, which is Bloomberg Edge, where Jayesh Kilnani talks about a pattern that the Bloomberg terminal has thrown up on a particular stock. Jayesh, what's the stock today?
DLF is in focus, Devina. That is because on Friday it managed to close below the 100-day moving average, while it is already trading below the 200-day moving average as well. And Bloomberg's fear and greed indicator has turned negative, giving a sell signal. First, let's have a look at the fear and greed and the theory behind it. It's a proprietary Bloomberg indicator which uses the spread of two weighted averages of the concept of average true range as one of the key inputs for calculation. And it oscillates on a zero baseline, therefore becomes very simple to interpret. Now, the conditions that you have to watch out for is just simply follow the color to get your buy and sell signals. When red turns to green, that's the buy signal, and on the other hand, when green turns into red, that is your sell signal. And this is exactly what has happened on the chart of DLF. Let's have a look at the chart. Now, that's the YTD chart of DLF, and you can see that this white trend line that I've drawn shows that how the stock has in fact been in a downtrend. And the bottom panel shows you the fear and greed. You can see that when you zoom into it, that as of Friday, it has actually become negative, which is the red color, which means that there could be further pressure on the stock going forward as well.
Past indicators for this one, Jayesh?
Neeraj, last 1 year average trade return has been about 3.7 to 4%.
Okay, let's wait and watch if this one reacts. Thanks a lot for that, Jayesh. DLF didn't fall too much, of course, Friday session, but let's wait and watch if there is more in store. Ruchit, what are the stock strategies that you have for our viewers today?
See, on the buy side, we have a buy call in Biocon. In spite of the volatility or the down move that we have seen during last week in the indices, this has been one of the stock which has been bucking this trend. And the uptrend is likely to continue going ahead, since on the weekly chart also we had seen a breakout considering last week's closing. So Biocon is a buy at current levels, keeping a stop loss below 657 for target around 709.
Okay, on the sell side?
On the sell side, there are a lot of mid-cap stocks that we are looking at to sell on bounce, because the risk-reward ratio right now is not that much favorable post the recent sell-off. Adani Enterprise is one of the stock which, after giving a very significant rally in last 3-4 months, now has given a breakdown from its consolidation phase. So I think if one has to capture any stock that could give a sharp down move, then Adani Enterprise could be sold on a pullback move around 143 to 145. 151 would be the stop loss, and 127 would be the first target area, and in case 127 is breached, then 200-day moving average is placed around 115, which could also be tested.
Anything on NBFCs? I mean, forget the ones which had cuts of about 40-45%. I'm talking about names like an Edelweiss, a Motilal Oswal. Anything there?
I think the stocks, one should definitely look at the stocks which have already shown an underperformance during the recent up move. I don't have any specific strategy on the names that you mentioned, but Can Fin Homes is one of the stock that had shown an underperformance during recent up move. Although within the housing finance space, if we see, except Friday's trading session, many of the names had been doing good since last 1.5 or 2 months. But in spite of that positive momentum in housing finance companies, Can Fin Homes is one of the stock which has continuously been underperforming the broader markets. So at current levels also, it seems that this downtrend would continue. 310 now would become a very strong resistance for short-term trading perspective, and I think Friday's low, which was around 260, 265 range, that would be tested again. So one can look to go short on Can Fin Homes amongst the NBFC space, keeping stop about 312 for expected target around 260 to 265.
Should be interesting. I think the good part is, though, that that almost all the powers to be have come out and assured that there is no panic in the money markets. There have been odd instances or two, and yes, it will be a lot more tight than what has been in the past, but no reason to panic, and enough liquidity will be provided to NBFCs if the need will be. So I think this whole...
Nonetheless, there are any which ways, most of them have enough and more liquidity to cover all of their obligations in terms of their liabilities and their payouts. We had the managements also of DHFL and Indiabulls Housing Finance coming in and reassuring investors, saying that there is no likelihood of a default. They are very well covered in terms of the kind of payouts that they have to make.
Yeah, all of that. I think the fear, if at all, would only be what happens to NIMs going ahead, and if they get compressed for some of the smaller ones, would that be an issue? Avinash, would you go out and use this crisis? I mean, never let the crisis go waste, right? That's the best way to probably be in the markets. Would you use this crisis to buy any of the well-performing NBFCs?
I think, companies like Edelweiss, or for that reason, even Indiabulls Housing Finance, I think clearly their capital adequacy is pretty solid at 24%. They have liquidity to the extent of almost 20,000 odd crores. So I think clearly, obviously NIMs would now be coming under clear observation, considering that interest rates are now going to get elevated. But overall, I think these are well-managed companies, and I think they should be able to, take care of the expanded kind of interest costs. And obviously, the next couple of quarters, what kind of of management commentary comes out from these companies is pretty important. But I think Edelweiss and Indiabulls Housing Finance clearly look to be quite good. I think I would definitely go out and buy them.
Okay. Just a few names that got badgered in trade on Friday. So you had the likes of, even in the sugar space, the Bajaj Hindustan was knocked out by 10%, Baram Chini was down 10%, JP Associates was down 12%. So these are the kind of losses that we saw in Friday's session. Ruchit, in the sugar space, the reversal has come in. There was that exuberance, around the ethanol announcement, but post that now looks like, it's come back into the grip of the bears. What's the sense here? Is there any technical indicators on sugar?
Certainly, the volatility in this space has increased significantly in the last couple of weeks. Now, if I just take an example of Balrampur Chini, last 3 months the stock prices has consolidated in a very narrow range. We had a breakout on the back of the news above its resistance of 80 rupees, and the breakout was also supported by very good volumes. So usually when you see such breakout supported by good volumes, there should be a trended up move. But there was no follow-up buying, a couple of days of up move, which has completely been retraced in this downfall on Thursday and Friday. So I think usually this mid-cap or small-cap names would tend to trade with such volatility, where even breakouts good breakouts would tend to fail. I think one should stay away from mid-cap and small-cap names if anyone has to do bottom fishing or buying at current levels. Let the volatility settle in first. When the volatility goes down, then I think we would get some better trading opportunities within the mid-cap and the small-cap space.
All right. Just stay on, Richard. We'll come back to you in moments from now. Market pre-open. We've got about 20 seconds left to go. Not much in terms of Asian market cues, just Hang Seng, which is trading, which is down about 1.24%. Since the last time we checked, it's recovered a bit, but still a heavy cut of more than 1%. For SGX Nifty, we're trading under marginally by a 10% or so. So the Indian market opening, pre-open at least, on your screens for the Nifty down by quarter, and the Sensex trades higher by about 1/3%. A quick look at what's been happening on individual stocks before we move on to the broader market. So we'll see a stabilization of these prices, but a quick glance at Nifty 50 and to see what's happening to an Indiabulls Housing Finance, because that one on the index and a Yes Bank, these two stocks in Friday's session were taking heavy knocks. Indiabulls Housing is up 10% in trade, and rightfully so. Coming out, most of the credit rating agencies have reaffirmed their credit ratings. Yes Bank, which is up about 1% right now. Maruti is up about 2.7%. IndusInd Bank is up 2%, Cipla is up 1.8%, you've got a Z which is up 1%, ICICI Bank which is up 1%, SBI, Sun Pharma, L&T, these are stocks which are gaining ground. Tech Mahindra is also up, ITC is up 0.5%. So the mood seems to be more positively bent, but you have losers. Ultratech Cement is down about 3%. You've got Power Grid which is down 2%. Tata Steel is down 10%. So obviously these are prices which will change. Just the pre-open tick is showing you a 10% dip on Tata Steel at 562. Remember, we had target price upgrades to the tune of about 57% on the back of the Usha Martin deal. The stock, however, has shown a negative reaction in today's session.
Yeah, I think this will change for sure. It's a net positive if indeed brokerages are to be believed. Let's wait and watch. Speaking of Usha Martin, let's see if that one is trading at all in the pre-open session. Yeah. Well, some gains thereof. Let's wait and watch if these last or no. DHFL is showing an uptick of 10%. Let's wait and watch if that happens or no. The other one that got hammered is Infibeam. It gets caught in the crosshairs whenever the stocks of these nature tend to fall off, and that one was down about 22%. For now, showing an uptick. Let's wait and watch if that lasts or no. What else? ITD Cementation has won some orders. That stock is up about 6% in trade. It's a good start for that one. Central Bank got pummeled in trade in Friday's session. Let's see what's happening today. Well, for now, showing some downticks. Let's wait and watch what happens there. Now, for a lot of these NBFCs, there will be different reasons that will come into play, different rumor mills that will be moving around. So please be very careful when you're trading this, because you would never know what news or what rumor would impact what stock on what day. It just becomes very, very difficult to trade these. So just be slightly careful when you're trading some of these names. Last but not the least, just see the currency and the bond yields and see what's happening thereof. The rupee, 72.47, well, a bit of a downtick there, and a strong one, about 26 odd paise on the rupee, down right now, 72.45. The bond yields, which had relatively weakened a bit, 8.09, so they are steady. The currency's taken a bit of a stick on open. Let's see if this lasts or no. Okay, by the way, I don't know why Spark has this unnatural downtick. I think that too will correct itself. Avinash, just a quick thought. Would you go out and prefer banking stocks over NBFCs currently? I think that's the call that is coming in from a couple of brokerages. CLSA has put out this note. They are saying we want to stay away from NBFCs right now, go out and put money into banks and large private sector banks as well. Would you be doing that? And if so, what would you buy?
Yeah, I think that would be a more safer strategy, Neeraj, considering that most of the NBFCs are now going to be hit by the rise in interest rates. So I think private sector banks like an IndusInd or maybe a Kotak Bank definitely could be better choices as compared to pure NBFC players. I think although it's quite obvious that the rate hike is definitely going to come in, our sense is that looking at the kind of sentiment also which is prevailing, I think private sector banks could possibly be more stable players in the current scenario. So something like a Kotak or a IndusInd Bank could definitely be looked upon from a long-term perspective.
All right, just stay on with us. State-run company Garden Reach Shipbuilders will look to raise about 345 crores from its IPO that opens for subscription today. Samit Sarkar, he's here with all the details you need to know about this IPO. Samit.
Well, this is the sixth company coming from the government side with an IPO in 2018. Now, the company is looking to raise close to 345 crore rupees at a price band of 115 to 118 rupees per share. And at the upper end of the price band, that is 118 rupees, the company will be valued at close to 1,350 crore rupees. Now, it is a shipbuilding company managed by the Ministry of Defence, and it conducts shipbuilding activities mainly for the Indian Navy and for the Coast Guard. Along with this, it also has engineering and engine production activities, but it gets nearly 90% of its revenue from shipbuilding activities. Now, it has around 3 facilities in Kolkata for shipbuilding, and its order book as of July 31st was more than 20,000 crore rupees. Now, along with this firm order book of 20,000 crore rupees, the company has also been declared as the lowest bidder for these 3 separate orders, where it has to make 4 survey vessels, 8 anti-submarine warfare machines, and 1 ocean-going passenger vessel. Now, if you see, the company's only listed peer is Cochin Shipyard, and compared to that, over FY13 to FY18, if you see, the company's revenue, net profit, and EBITDA growth rate was subdued. But the company's revenue had declined because of a slowdown in order execution. On the EBITDA front, the company has seen operational losses for FY17 and for FY18 because of higher material costs and employee costs. But on the net profit front, the company was able to report a net profit despite operational losses because of higher other income. Now, if you see the company's balance sheet, it's a debt-free company with a huge cash balance of close to 1,000 crore rupees. Now, Cochin Shipyard also has a cash balance of 3,500 crore rupees, but it has a planned capital expenditure of nearly 2,700 crore rupees. Now, the company's return ratios were also subdued compared to Cochin Shipyard, and that was because of the operational losses. For FY18, the company's return on equity was 8.5% and return on asset was close to 2%. However, the company has a strong order book which gives a good revenue visibility of nearly 15 years. The company's order book is 20,000 crore rupees, which gives a revenue visibility of 15 years. But this does not mean a profitable growth for the company, because most of its contracts are on fixed price basis, and any higher cost will need to be borne by the company and cannot be passed on to the customers. Lastly, in the valuation, if you see the on price to earnings, it's expensive compared to Cochin Shipyard. For FY18, the price to earnings is nearly 15.6 times as compared to 14 times of Cochin Shipyard, while on price to book and market cap to sales, the valuations are not that expensive. Price to book is 1.3 times for FY18 and market cap to sales is nearly 1 times for FY18.
All right, Samit, thanks very much for that. So that's the new issue that's coming out today. Indiabulls Housing Finance is now up 6.5%. Yes Bank is up 4% on the index. So, and Tata Steel, obviously, the initial tick of 10% that we saw, that's cooled off, and now the stock's down just about 1% or so. Let's bring in Jyoti Vardhan Jayapuria, founder and MD at Veda Investments. He's joining us on the show right now. Thanks very much for taking the time. Your sense, and what would you do in the market setup like this, Jyoti, just to get a sense of whether or not this panic was warranted, and how does one approach investing now?
Yeah, so I guess if you look at the background, the markets are expensive, and to that extent, when markets are expensive, they are quite vulnerable to any external shock which happens or anything which goes wrong. I think it's a market which probably needs to pull back a bit. It's done very well relative to what other emerging market peers have done. And if you look at the trading band, it's trading way above what all emerging markets are doing. Historically, India has always traded at a premium to emerging markets, but now the premium has expanded even more. We are trading at nearly 65% premium to emerging markets. So in some sense, it's a market which is expensive, and to that extent, a bit of correction would probably be healthy, because it will get us back somewhere in line with historical averages.
Jyoti, good morning. Neeraj here. These some of the stronger NBFCs too, which are a part of collateral damage in Friday's session. Would you believe that there could be some merit in shortlisting names, or are you on the side which believes that because of the rising cost of funding and all the uncertainty surrounding the money markets, there could be sentimental or otherwise some pressures on the NBFC space in the near term?
So, like even before Friday's move, I guess, most of us believe that NBFCs will see some pressure. Like they had a sweet spot last year where interest rates were falling. And so, what we were expecting was there would be some NIM pressure going forward because interest rates were rising. And in such an environment, NIMs do get compressed a bit. Longer term, of course, NBFCs look very attractive because, over the 3-year, 5-year period, we know that they'll gain market share, public sector banks will lose market share. So that's like a very consensus call, and I think that is something which will play out. If we look at NBFCs now, what one needs to look at a little more carefully is the asset liability mismatch. So NBFCs which have a lot of loans coming due in the next few months, and where the assets are probably lent out for the longer period than what the loans are due, those are the ones we have to be a little careful about, because they may not be able to just roll over their liabilities like it used to happen in the past. So that's one thing we have to be wary about. But otherwise, like I think markets are a little expensive, we'll probably see correction in the NBFCs also. And for some of the stronger NBFCs, I would look at some of these as buying opportunities where you get a chance to buy some of these much cheaper than what they were last year.
Okay. Would these stronger names be in the housing finance space or non-housing finance, Jyoti?
Like I said, so there are 2-3 things we need to evaluate. So they could be all across, they need not be in the housing finance. One is, the asset liability mismatch is a key thing to look at. The second is the valuations, because a lot of the companies in the housing finance had become actually very expensive, and there were, cheaper NBFCs in some of the other spaces. So those are probably the 2 things which we need to evaluate when we are doing, what stocks we want to buy.
Okay, stay on, Jyoti. Minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. First up, Tata Steel has made another acquisition this year. The company will take over Usha Martin's steel business for 4,300 to 4,700 crore rupees.
Good news for Biocon. US FDA has completed its inspection at Biocon's Bengaluru facility with no Form 483 being issued. Biocon, along with Mylan, has also received positive commentary for its drug Fulphira from the European Medicine Agency's committee.
Watch out for ITD Cementation as the company is back 2 orders worth 845 crore rupees, one for the upgradation of facilities at the Trichy International Airport and the other to develop refit jetty and Port Blair.
Bajaj Hindustan and Marksans Pharma will be in focus. Vanguard Group has sold partial stake in both companies via bulk deals.
Ship manufacturer Garden Reach Shipbuilders heads to the bourses as the company opens IPO for subscription today. Issue price has been set between 115 to 118 per share.
And in brokerage calls, Credit Suisse sees upside in Marico on copra prices facing a downward trajectory.
Well, interesting. The pre-open rates are settled, and something that me and Devina were talking about. Some of the NBFCs are starting off on a good note. Ruchit, would you trade any of these? I won't put you in a dog by asking about Diwan Housing, but Indiabulls Housing Finance or Yes Bank, either of these 2 names, the large ones, nifty names?
Not really, Neeraj, because certainly the pullback move would be sharp because of the sharp downfall that we have seen. But guessing any what stop losses would be there in such volatility, it would be very difficult. So from a trading perspective, I think definitely traders should tend to avoid this NBFCs as of now.
Okay. Avinash, before we let you go, anything on some of these PSU banks, the likes of Central Bank, etc., which have fallen quite strongly? It's down 20% again today.
I think Neeraj, clearly we would like to avoid the PSU banking pack largely because I think clearly we could see 1 or 2 bad quarters of further asset quality stress, and I think central bank has been been on the downside for the last few weeks. In fact, Friday was a bad day for the central bank stock. I would believe that apart from the asset quality stress, I think incremental loan book growth is going to be a kind of a problem for these banks. So I would believe that it's better to stay put for some more time. I think the larger banks like maybe an SBI or typically a Bank of Baroda could be looked upon. I think SBI definitely seems to be much better positioned, considering that most of the asset quality write-offs have already taken place. So I think the smaller PSU banks, I think, could see a little more pressure in the coming few weeks.
All right, Avinash, thanks a lot for joining and really appreciate you taking out the time and speaking with us. 1.5 minutes left to go for market opening. Before I get closing strategies from Ruchit, Jyoti, just coming to you on the oil marketing pack and whether or not it's an attractive space to be in at this current juncture.
So there are 2 things I'm worried about over there. One is oil prices are going up and we have the currency pressure. So to that extent, they've kept having to increase prices at the consumer level. Second is we are entering into a election season. There are lots of elections. So there will be that pressure somewhere for, the government to tell these companies that you can't hike prices now. You absorb part of this gain. And that's the reason why these stocks are not doing well, because, people are worried that they may have to take a hit on marketing margins for the next 6-9 months till the elections are out of the way.
All right. Ruchit, quickly, your opening stock idea?
I would recommend buying GAIL for intraday today. We had seen a firm closing on the weekly charts on Friday. The opening also seems to be on a flat note, and the risk reward issue is also favorable for fresh trade. So keeping a stop below 380, one can go long on GAIL, expecting target around 405 to 407.
Okay, so that's the top call from Ruchit. Ruchit, stay on. We'll probably take an opening thoughts, but here's how the markets are likely to start off today. Well, a fair bit of, well, maybe a little bit of green, not a fair bit of green, which we'll start off with. Let's see if that lasts. For now, 0.2% higher for the Nifty and the Sensex. The Nifty bank quickly slipping into the red, by the way. The mid-cap, actually even the Nifty and the Sensex, very tepid trades. And both, even for the mid-cap and the small-cap indices, not really quite gung-ho. Bring up the heat map and let's see what's happening to the market breadth and maybe specific names. Yes Bank continues to stay in the red. So 1.5 reason, remember, not quite connected to the fall that happened post-noon on some of the NBFCs, but Yes Bank right there. OMCs correct a little bit after starting off well in Friday's session. And on the gaining side, you don't really have those 6% gains in Indiabulls Housing Finance, just about 1.5%. But even Stevens right now between the red and the green. So a relatively calm market at the start of the trading day today. Quickly highlight a couple of pockets in terms of movers and gainers before I hand it over to Devina for what's happening across the markets. Firstly, top losers in Friday's session, the likes of Dewan Housing, Infibeam, Central Bank, and let's see what's happening there. DHFL, well, 23% uptick, very volatile stock, very difficult to trade, but for now, showing an uptick. Infibeam, after 22% dip in Friday's session, up about 7%. Central Bank, though, possibly other reasons, down 20% in Friday's trade and down 12% today. What about stocks in news? Tata Steel and Usha Martin, both of those names. And Usha Martin certainly has some gains, 8% higher for this one in the session today. Last but not the least, NBFCs as a pack fell in Friday's trade. Let's see what's happening to some of these. Edelweiss, marginal green, Canfin Homes, well, about 1%, but Repco Home continues to grind lower. As we speak, Edelweiss too has slipped into the red. The index, Devina, 1/3% lower.
Well, at least for the broader markets, there are a few specific stocks which are doing okay, picking up, though the index is not doing all that much. So the advanced decline ratio at the start of the trading session more tilted towards the negative side. However, Infibeam, a stock which was beaten down badly in Friday's session, is up about 5% right now. We've got Nal FS Transport, which is up 2.5%. You've got Welspun India, which is trading higher by about 1.5%. JNK Bank, 1.5% higher. You've got Monsanto. You've got Zensar Technologies at 282, McLeod Russell 153 on the stock that's trading in the green. Gati, you've got a Magma FinCorp, which is up about 0.5% in trade right now. So yes, while the the number of stocks gaining are not much. You have a few meaningful gains in some of them. Amongst the losers, you've got a JP Associates down 5%, a Radico Khaitan is down 4.5%. From the sugar space, Bajaj Hindustan is down 4%. HDIL, which is down 3%. Jet Airways again continues to look a little bit weak. Welspun Corp is down 2%. BEML is down 2.5%. And the likes of a Raymond, you've got a Dena Bank, which is down 2%, and even a Vijaya Bank looks a little weak in trade by 2%.
Interesting. Ruchit, any opening thoughts? Anything pops up on your screen?
Bank Nifty itself, I think, is an indication of how the markets could be. We had seen an underperformance in the Bank Nifty in the recent past. During the corrective move in last couple of weeks, the Bank Nifty had corrected more than the broader markets. It has given a closing below its 200-day moving average, and today's opening also does not seem to be much positive. There is no pullback move also in the opening trade. So I think this banking and financial space, this would continue to drag the markets on the lower side.
Okay. Thanks a lot for that, Ruchit. Thanks for joining in today and giving us that perspective. But, well, the Nifty Bank clearly showing chinks in the armor, and that continues to grind lower. By the way, the pressure points are not off. Bajaj Finance is down another 3.5%. So that's now sub 2,300. Indiabulls Housing Finance continues to grind lower as well. Bajaj Finserv is knocking on the doors of 6,100. So large, stable NBFCs coming under pressure. Jyoti, I repeat that question which we asked at the start of the show. While the long-term growth story on NBFCs may remain strong, sentimentally or otherwise, and actually fundamentally too, could there be pressures on some of the high-quality NBFCs as well? I was reading a CLSA note which said that typically, I mean, in the last 1 year, spreads for the BBB rated NBFCs have expanded about 200 basis points on the upside. And if indeed the RBI goes as the hike rates, the cost of funds move up, then some of the smaller NBFCs will get impacted. But right now, we're seeing the larger ones also getting hammered.
Yeah, part of the reason is the valuation, because if you see some of the larger NBFCs, over the last 2 years, they've got re-rated tremendously. So you have a lot of them trading at like 4 times price to book, 5 times price to book, etc. So those are the NBFCs where you're seeing a bit of valuation compression, because it's good quality, people want to buy it, but it's the valuation which you question, especially in an environment where, once the NIMs start to compress, it will compress for everyone. It's like it may compress a bit for the larger ones, and the better ones, it may compress a lot for some of the smaller NBFCs, but they tend to compress for everybody. And at that time, if your valuation is extreme, then that's where you start getting worried that we could see a valuation compression, and nobody would really wonder why the valuations are compressing. So that's the risk always when you're playing some of these things, that near term, when the environment turns bad and if valuations are very high, then you can get a valuation compression.
What's your take on liquidity in the current scheme of things? I mean, while most of these NBFCs have actually come out and said that they're very comfortable on liquidity, I mean, is that not just within NBFCs, but for some of the smaller banks, can that be a little bit of a problem in this interest rate regime?
So, I think it's not so much the liquidity, because, a lot of them are assuming that they'll be able to roll over. But I think it's going to be the cost of funding is going to go up. And there is, a difficulty in passing that cost of funding straight off, because over the last 2 years when the cost of funding was going down, it was not like they have passed on everything. They managed to increase their spreads. And so in an environment like this, when the cost of funding goes up, what we are going to probably see is a bit of compression in the spreads. So, there'll be NIM compression which will come through, and there could be a bit of, hesitancy in rolling over everything. So if there were some NBFCs which were running a very high ALM mismatch, where, they were borrowing short term and lending long term, those are the NBFCs which will see most pain coming through. But even for people who are running a normal ALM, they'll probably see some compression in the NIM. So I think, it's the NIM compression which is going to start hurting valuations.
For banks, and my question is pointed towards what the PSU banks are doing currently, and the kind of measures that are being taken for consolidation within this space.
Yeah, so the PSU bank consolidation, what happens from a minority shareholder point of view is that if you have a good PSU bank which you're holding, the risk is that you'll be stuffed with one or two not so good PSU banks. And so, that whole entity asset quality may become worse than what it was when you were holding the standalone shares. So to that extent, it gets a very tough call for anybody who's a minority shareholder, because you don't know what bank will get merged with your bank. Now, of course, we've seen one of the consolidation happening. Maybe there's nothing more on the horizon, but that's a risk which, a lot of investors have to factor in. It's, it's not like PSU banks are something which people are dying to hold. So most people have stayed away from PSU banks for a long time. And the only reason why, one was starting to look at it is you're sensing that probably you're coming closer to the end of the whole NPL cycle. And to that extent, maybe there's a bit of bounce in these PSU banks. You could probably have a few good quarters. But if across that you get a sense that, the consolidation could become a bit risk for minority shareholders, I think most people will just choose to stay away from these PSU banks.
Okay. Jyoti, the larger question then remains that what would happen to the market mood, considering the factors that have already been at play for the last 2 weeks. I know, in the last couple of days, NBFCs and specific names have come to the fore. What this whole twin deficit and the currency and how India does in the near term because of all of these factors stay. Would you believe that volatility would be the name of the game, and for the next 2 or 3 months until the state election verdict is out in December, it would be better to stay on the sidelines and be very, very selective?
Yeah, I think, you'll get volatility over the next few months, and I think it's not going to come so much from the state elections, but it's probably going to come from the international environment, because one is, you have Fed, which is raising rates, they'll raise again in this week on Wednesday when they meet. So it is like, do they go for another rate increase in December, or do they stand still, and what is their outlook for the next 1 year rate increase, which is what people will be watching, because there's a press conference also along with this meet. The second is, the trade war, which somewhere, a lot of people had thought would get settled, but suddenly we've had China, which has, pulled out of trade talks now. So they are probably sensing that maybe till the November elections in the US, there's no point in having a trade talk, they'll do it later. And sometimes some of these things have a habit of suddenly upsetting you a lot. So there are a couple of things on the horizon in the world which probably is going to cause volatility. You've seen a lot of volatility in emerging markets. India has in some sense been a safe haven in that whole environment till we had this Friday bubble. But otherwise, I think India probably still remains relatively a good space. But I think the world is going to be quite volatile over the next 6-8 weeks. And I think the Indian markets will also be a volatile space.
Let's look at the indices now down below that 11,100 mark on the Nifty. Remember, we saw almost about 1.5% cut on Friday. Again, if this pain starts to exaggerate from here on, this is not bad considering the kind of move we saw on Friday. But if it does worsen from here on, then you could have a few margin calls getting triggered, which could lay further pressure on individual stocks. 37 points down on the Nifty. The banks are worse off, so about more than 0.5% on the Nifty Bank. 25,419 is where it's currently trading, and Bajaj Finance is now at 2286, and M&M, Hero MotoCorp, also under pressure by almost 2% a piece. Jyoti, what does one do here in the auto pack?
So, the autos have had a good run, and what we've been playing has been the tractors more than any other segment in the last few months. So we like tractors followed by commercial vehicles. That's our pecking order within the auto space. So, and probably the others are, because the passenger vehicles have had a great run, and we think now relatively there's more money to be made in these other two segments.
Do you have a call on the two-wheeler space, and in particularly the dynamics between the two major players here, and what's been happening in terms of their product portfolio and their offerings and the rejig there?
Yeah, so like if the majors decide that they want market share at the cost of margins, then from a strategic point of view for the companies, it's like probably the right thing to do because they can always get margins later once they've got the market share. But from minority shareholder point of view, it's like in that battle over the next 6-9 months, we may not really make money if the margin pressure starts to get more acute. And that's the reason we preferred playing other spaces where probably there's a bigger volume growth happening and the environment within the competitive space is a little more stable.
Jyoti, just thought with the currency depreciating the way it is, everybody's talking about the kind of export beneficiaries that come in, but on the other side, sectors or themes that were getting impacted by imports when the currency was at 64 or 65, and now that change that happens because the currency is at 72 half odd and maybe likely to depreciate further. Are you looking at the other end of the basket at all?
So the answer is yes. Actually, we are looking at the other end of the basket. So when you look at currency, the depreciation, what's happened is what it does is it increases the price of most commodities. So increases price of steel, increases price of any of the oil related plastic manufacturers. But we still actually quite bullish on some of the consumers of steel, especially in the capital goods space, because my call is that we're just starting a cycle of 3-4 years where we'll probably see more demand coming in for a lot of these players. They're all sitting on the capacity utilizations which are not very high. So for the next 2-3 years, they'll be able to expand their utilizations and there'll be huge operating leverage which will play out through them. So though near term they'll have a pressure because their raw material prices are going up, they'll ultimately pass it on, but that probably is like a 3-month, 6-month phenomena. And so there could be margin squeeze in the next 3 months. I think we are looking at that as an opportunity to buy into some of these for the next 3 years. Because the key is once you get operating leverage in them, then the margin expansion can be very large. And these are sectors which are underowned, they have underperformed. So from a investment point of view, your downside risk is quite limited and you can have a big upside coming through.
Okay. By the way, Jyoti, just a quick thought here. My last question really on the upstream names, Oil India, ONGC. Somehow the last few days they've shown some metal. Is there reason to believe that there could be some positive fundamental reasons for the same?
So whenever oil prices go up, it's obviously good for them, and so they benefit. Oil goes up, plus you have the rupee which is depreciating, so on a landed basis you make even more money. The only thing which we've seen historically is beyond a point they're not allowed to retain a lot of those profits. So in some way or the other, either they end up subsidizing some of the downstream players, or they end up subsidizing something else in the government. So they are interesting if they are allowed to make normal margins, which one would in such a environment where oil prices are going up. But we have generally not been very big fans of such companies, because what we've seen is ultimately somewhere government takes away the excess profit which they make.
All right. Jyothivardan Jaipriya, thanks very much for joining us. Really appreciate you taking out the time and sharing your views on the show with us. Well, let's quickly take a look at the indices before we wind up this leg of Indian Open. The Nifty as well as the Sensex, both of them down about 1/3%, with the Bank Nifty shedding almost 3/4%. So a little bit of a nervous setup this morning.
Well, certainly so, and let's wait and watch how this shapes up. On the other side of the break, though, we talk about the concerns over liquidity in the NBFC space with Mahendra Kumar Jaju of Mirae Asset Global Investments and Lakshmi Iyer of Kotak AMC. And what does the country's largest NBFC make of the credit concerns? A conversation with Keki Mistry of HDFC.
Good news, guys. Got a promotion and a damn good raise.
Congrats, beta.
Congrats मेरी तरफ से भी.
From mama too.
वाह, रेज. अब तो इंश्योरेंस पॉलिसी ले ले.
इंश्योरेंस? कौन सी कंपनी से लूं?
सोचना क्या? चूज वही जिस पर हो पूरा भरोसा.
वीरू, go for convenience. My company is online, quick and simple.
बेटा, बट पॉलिसी समझाएगा कौन?
वेबसाइट पे सब है पापा. I can even call and ask.
क्लेम सेटलमेंट का रेशो क्या है? मेरी कंपनी का 98% से ज्यादा है.
That's good, but आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
अरे पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC ट्रेंडिंग विद टाइम्स 62 सालों से हर जनरेशन की पसंद.
When I started juicing to bounce back from a serious injury, I had no idea that it would turn into a passion, that would turn into a brand that provides healthy choices to millions of consumers. Today, my brand is a household name. I am Anuj Rakhian, and my story is a clean and a flavorful one. I'm the raw pressery guy, and I'm here to tell you my story only on Aegon's of Business.
Aegon's of Business never stop. Only on Bloomberg Quint.
And I want to talk about how disruptions are coming and how we'll have to weave that into our portfolio, into our investment thesis. Because clearly in this whole, world of disruption, there will be few winners, but those winners will make tremendous amount of wealth.
Back with Indian Open right here on Bloomberg Quint. Let's talk about the credit markets and the debt defaults by IL&FS and the group companies have triggered some concerns across these markets. Contagion spread to NBFCs in Friday's session as well. Now, debatable whether the fall in DHFL was due to this or some other factors as well, and lots of rumor mills doing around. But the good part is that the finance minister and the regulators have stepped in to try and assure investors that there is no panic in the markets. So as the country's largest lender, which is State Bank of India. So is the going to get tougher, or will the assurances provided by SEBI and RBI prove enough? More importantly, is there reason to panic or no? Let's pose this question to two experts. Lakshmi Iyer, the head of fixed income at Kotak AMC, one of the fund houses which also has some exposure to IL&FS, and she's been on record a number of times on the website already talking about their stance. And Mahendra Kumar Jaju, also head of fixed income at Mirae Asset Global in Management. Both of you, good morning. Thanks so much for joining in. Lakshmi, I think this got a lot more focus because of a bond sale from one of the fund houses of a small amount, which triggered concerns around the liquidity in the said NBFC and some of the other housing finance names as well. And my question to you is, do you believe that the liquidity in this market is so tight that fund houses, if they face any kind of redemption requests, might have to take those steps of selling off the bonds at a higher coupon in order to meet those liquidity constraints?
Yeah, hi, morning Neeraj, and yes, your question and your observation is definitely bang on. This is a market where, when there is a situation like this which emerges, the tendency is to get into a groove. And I'll give you an example to illustrate this. So at Kotak Mutual Fund, for example, for the last whole quarter or so, we have been maintaining defensive positions and we've been maintaining cash on the portfolio. Ideally, this is the time to go all out out and try to buy bargain. It is a buyer's market very clearly, but there is a tendency to pull back, saying that no, what happens even if I don't have any exposures to the names which are floating around in the industry? What happens if there is a redemption, which is generally en masse? So the tendency is to say that okay, I will postpone my buying decision, and that is exactly what is happening in the bond markets right now. If you accentuate, what is getting accentuated further is that this is the month where there have been advanced tax outflows, and also we are nearing the month end where you usually see institutional investors redeem from the mutual funds, specifically in liquid funds. So I think a lot of these factors are coming in together. It is very difficult to say whether it is the tail wagging the dog or the dog wagging the tail, but each of these sum of total parts, and obviously getting exacerbated by the fact that there have been couple of high yield sales in the market, is compounding to this issue. The second key thing which you observed is that the bond markets have remained like this, especially on the corporate bond side, where the secondary market liquidity is not very high. So it's very natural that if in a market like this, I sell a small lot of 25 to 50 crores, the next bid will be 0.25% higher or maybe 0.5% higher, depending on which asset is being sold. So I don't think any sector or any particular rating profile per se in this market is being spared. It is the magnitude of yield rise that is actually making the difference.
Yeah, but you know, I mean, let's not term it a freeze at all. And Mahendra, I want to come in on this. Call rates were barely above repo. I mean, typically, if the situation is even remotely close to a freeze, you would see these rates moving up substantially. That was not the case. How is I know liquidity for select papers might be tight, but is overall liquidity very, very tight, or is this something that has happened in the past as well, and we waded through it?
So I think Lakshmi broadly described what's happening in the market currently, and there is a structural systematic liquidity shortage in the system given the seasonal patterns in the market, etc. On Friday the things were looking very, very difficult. So over the weekend I think a lot of action has happened. Most of the companies which were under discussion have come out, clarified about their liquidity, about the ALM. Reserve Bank and SEBI have made a joint statement. Finance Minister has spoken. So I think the Monday doesn't look as bad as it would have in the absence of such a strong action over the weekend. Now having said that, the things are obviously still very, very challenging. The net system liquidity remains in the negative. The interest rates are going up. The oil prices are back very close to 80 rupees, again going towards 7 to 250. So I think the pressure will be there, but I feel that the industry is well equipped to deal with it. I think this is one of the time also to remind the investors that the mutual funds give the safest and the fastest exit, and that could be one of the reasons that people, if they start panicking, the first thing they can think of is redeeming from the mutual funds, because it is such an easy process. So I think there will be pressure, but I think it's not looking to me as at this point that it will evolve into something of a bigger order crisis for two reasons. I think regulators have taken a quick note, and the mutual fund industry is very well prepared to deal with this situation.
Yeah, interesting. I think the regulator's assurance is coordinated from SBI, not a regulator technically, but the largest lender, so to say, and then the regulators, SEBI, RBI, as well as the finance minister today, assuring, which is, well, something that was much needed. Lakshmi, the question is, would there be needs, or do you reckon that if there is a large redemption request that comes in, then we could see some instances like this happening once again, wherein mutual funds and any house for that matter, not necessarily Kotak, not necessarily DSP, not necessarily Mirae, any house might be forced to sell off even high quality rated paper at a slightly higher coupon, because you mentioned that it's slightly liquid market and then these things happen. Would we see more instances of this, and would it be prudent for the markets not to panic at such instances, because they would naturally happen?
Absolutely, Neeraj. So as I mentioned to you, see what happens in equity markets when there is a pressure, when you need to liquidate, mid caps generally are less liquid compared to large caps. So mid caps get dumped later with a lag and large caps correct the first. And I think if I extend that analogy to the bond markets, in the case of heavy redemptions from an industry standpoint, the easiest thing to do is to sell your prized assets, which is your AAA assets. And that's exactly what will happen. So I think it is in the interest of the industry not to really panic, because we have seen this in the, over 2 decades of being in this industry has taught me one thing, that in panic, seldom are decisions made which are right. It may be right, but you will get to know with a lag. But I think it's important to, stay the course right now. It's very easy for fund houses to sell and meet redemptions. I don't think anybody will deviate from the stance of their stated redemption policy. But I think it's important that everybody maintain this calm, and through your channel, I think I would want to urge the viewers also that it is not a situation like 2008 where things have been blown out of proportion. There have been certain instances, and it is clearly a liquidity measure which is leading to these scenarios. And as the regulators have stepped in to calm the nerves of the market, if they follow it up with the necessary action, we will get to know through the course of the day much of this can get reversed in an orderly manner. So I think it's important to keep the calm. Else, what you said is absolutely right. If the redemption spree continues for the mutual fund industry, at a point in time you will not be left with, forget Brahmastra, you will not be left with any weapons. So what do you end up doing is whatever is available with you, you go and start liquidating that in the market.
Are you seeing that? I mean, did you face any large redemption numbers, or did you hear of something like that happening on Friday, or something like that happening today? Also because the ILFS situation, Lakshmi, is a moving piece, right? Over the weekend, there have been good news and bad news. The MD and CEO has stepped down as well. But RBI is meeting. We learned that the RBI is going to meet the shareholders of ILFS, and Bloomberg News has looked at the internal memo which speaks about these asset sales, and they are comfortable with valuations received for 14 of those assets that they want to monetize as well. Is it possible to predict how good or how badly would this ILFS situation pan out over the near term?
So 2 sets of your questions. Answer to your first part, we don't have any abnormal redemptions as Kotak Mutual Fund. It is business as usual in terms of the normal liquid flows. Second, I told you in terms of ILFS exposure, we don't have any exposure to any of our open-ended schemes. So obviously that has been a lot of, that's given a lot of comfort to the investors. Secondly, yes, I fully agree with you that this ILFS situation is an evolving situation. The news that we also read with respect to Reserve Bank of India meeting the shareholders could be a positive development and helping them accentuate probably their asset sales, etc. But till such time that the meeting happens and the board meeting or the shareholder meeting concludes, which is slated for end of this month, I think the situation will remain fluid, and it is not appropriate to say that any concern with respect to ILFS is completely out of the woods. So markets will remain mindful of that and equally concerned as they are today, as they were in the past, till such time that there is a resolution which is arrived at. That will continue to keep the markets on tenterhooks for now.
Well, pertinent points out there, pointed out by Lakshmi as well. Mahendra, have you guys had any exposure to any of these in conversation papers, I mean the likes of DHFL and some of the others, and just wondering if the market is a bit concerned about the papers of some of the housing finance companies or NBFCs at large? Are you seeing that? Have you gone and sold out any of these papers in the last 2 or 3 sessions?
So to start with, we have no exposure to ILFS or any of its associated companies, but we do have exposure to DHFL. We haven't had to do any sales so far, and the redemptions are in the normal order, as Lakshmi was also saying. Now, there is obviously concern on some of these names. It's very normal when you get a shock of a blue chip company like ILFS getting into the difficulties, then I think each and every of the other part of the portfolio will be questioned. It will be scrutinized for all details, and I am happy that going by how the things have evolved so far, like you said, some of the names, DHFL has been a hot subject of discussion. They have got their ratings reaffirmed by the rating agency over the weekend. They have presented their ALM, to the investors at large, and then the Reserve Bank and the SEBI and the Finance Minister have issued comments suggesting that they will step in as and when necessary. Now that doesn't mean that they will help any particular financial company, but I think they will. The indication is that this whole situation is possibly a little bit overstretched. Now coming to the financial services companies or NBFCs in general, I think that has been the case for some time. There have been whispers about how in some cases the valuations are stretched, or in some cases the business growth is under pressure. So we are just coming out of a situation where we had a huge bull market on the equity side, which gave very stretched valuations to the issuers, and the interest rates were low with high liquidity. And when that situation changes, when there is a macro turnaround, some of the casualties will happen. People who were over aggressive will face the hit. My sense is that overall the mutual fund industry has done a good job on the credit side. I think the most of the exposure of the mutual fund industry is to companies of very good quality, high quality. So within the financial services sector, there will be pressure. Individual companies will have problem, but I think overall the industry is in a very good state.
It certainly looks like. Lakshmi, one final question really. Do you reckon the spreads for the NBFCs and the difference out there will expand meaningfully, AAA versus maybe a BB, more so because of the environment? And if indeed we do have what a lot of people believe the RBI will do, which is hike rates a couple of times in this current calendar itself, is that a real risk and a material risk for some of the NBFCs as well?
Definitely, I think the cost of financing for NBFCs alongside, if you see in the last 3 to 4 weeks have already started inching up. In that the spreads also have started widening. This event or the series of these events which have unfolded over the past couple of weeks will act as a further catalyst to see the NBFC spreads, the AAA versus the non-AAA widen further, and within the AAA and the credit sector also widen further. And while a rate hike is already baked into the prices, this sentiment will linger on for some more time, which means NBFCs, the cost of borrowing and expensive days for them are ahead.
Okay, both of you, thank you so much for taking the time out and being with us and talking, well, facts really. No reason for panic. There is no freeze situation, if at all. Yes, there are some concerns around liquidity. Thank you so much for joining in today and giving us those thoughts. Well, speaking of NBFCs, the country's largest home loan lender was also under pressure through majority of last week. And Friday's session, of course, did reasonably well, but was lower in 3 of the 4 trading days. Sajid Bangat spoke to Keki Mistry on Friday to find out what he made of the sharp intraday fall in most NBFC stocks, including HDFC. And Sajid, of course, started off by asking Mistry what could have caused such a drop.
Well, my sense is that what happened was that one of the mutual funds sold the paper of one of the NBFCs or housing finance companies at a much higher yield than what the market expected. And that caused a flurry of panic in the market because people started spreading a lot of stories and a lot of rumors that many of the NBFCs and smaller housing finance companies had funded themselves largely out of short-term paper. And a lot of that short-term paper was from mutual funds. And therefore, when this came up for maturity, and if the mutual fund did not renew the paper, then the concerned NBFC or housing finance company would not be able to pay the money back on time, and that could result in a default situation. So I think that was the fear in the market. To my mind, it is unfounded. I'm not aware of some of the housing finance companies or NBFCs, the smaller ones, and how they borrowed money. But generally speaking, the well-run housing finance companies would have matching assets and liabilities. So therefore, to short-term liabilities, there would also be short-term assets.
That's right, Mr. Mistry. You know, if you look at the market, how it's been doing for the last 2 weeks, especially after the IL&FS issue has cropped up. Yields for many of the housing finance companies have gone up sharply, especially in the shorter tenure. You know, do you see this as a point of concern going forward?
I don't know what you mean by a cause of concern, but yes, yields have been going up, but yields have been going up across the board for everything. You see, the external environment is also not very conducive to low interest rates. Oil prices being where they are, the currency being where it is, the current account deficit being where it is. I think these are all pointers to the fact that one should expect to move into a higher interest rate regime in the period to come.
You know, many of the NBFCs were also borrowing heavily from the market because the rates available in the market was much lower than rates available from the banking front. And do you see that changing now? And from an SGFC point of view, what kind of what percentage of your borrowing is from a short-term perspective and medium and long-term?
If you look at our website, we give a presentation which gives all these numbers, so I won't be able to speak off the cuff. But we have matching term assets and liabilities. If you look at the presentation, I think it's on page 23 or 24, where the asset liabilities of 1 year, 2 year, 1 year, 2 to 5 years, over 5 years duration is, we give those details. Just to run you some numbers, we don't take asset liability mismatches. We have more assets maturing in the next 1 year than we have liabilities maturing.
So in that sense, you know, it's you are well placed from there. But from an industry point of view, do you see some pressure coming on the on the industry because of the hardening of yields?
Well, I guess what the industry would also do is look at their lending rates on the asset side. So if the liability cost goes higher, the asset yields will have to go higher. So we are moving clearly into a higher interest rate regime. There's nothing specific to NBFCs or housing finance companies. It's an across the board sort of a phenomenon.
You know, the mutual fund which sold off nearly 300 crores of paper today said that they are trying to bring down their maturity period, and that was one of the reasons why they offloaded DHFL paper, and that had a repercussion on the stock price as well, because the market had some fears and rumors also started doing the round. Do you see today's fall on some of the stocks as a irrational way of looking at it?
I can't comment on specific stocks because I do not know the financial position of these companies, so it would not be fair for me to talk about it. But yes, the market movement per se was irrational, and the markets always tend to behave like this. So we've seen this in 2008, we've seen this in 2013, and we've seen this several times earlier before 2008 also. That when markets fall, it becomes an irrational fall, and the fall becomes sort of accentuated by rumors that keep getting spread in the market. And those rumors cause more worry, more fear, and that fear leads to more selling in the market.
Well, that's one more word of reassurance, but I must say the markets are not reassured at all. Look at what's happened to the Nifty Bank. It's down about 1.23%. The Nifty 2 down about 0.4%, dragged predominantly by what's happening to the banking space. NBFC is bearing the brunt. Bajaj Finance is the top loser on the Nifty. It's down another 4%, 2281 now. From a price of nearly 3,000, Bajaj Finance has shaved off at least 24-25%. Indiabulls Housing Finance down another 4%, that's 1,022. HDFC is down about 2.5%. Kotak Bank about 2.5%. IndusInd Bank about 2.2% as well. There's a lot of pressure on the rate sensitives in the session today. I don't know whether the screen is just telling us whether the RBI hike is in place or something else too, because there is pressure for sure. What's trying to thwart this? Infosys about a couple of percentage points. HUL, there's a defensive bent to the market right now, to be honest. Coal India is up about 1.5%. Cipla is up about 1%. So those names are doing well. Yes Bank, well, about 0.5%, but a lot of pressure at the NBFC space and at the financial end of the market, even on the Nifty 500 too, you can see those stocks right up there when it comes to the list of losers. Central Bank is still down about 14%. Edelweiss is now at 223, down another 5%. Repcom Finance correcting another 5% today. NBFCs is the talk of town right now. Take a break. In fact, wrap it up on this leg of Indian Open, but a lot of questions, I'm sure, around these NBFCs. The FNO show will take forward all of those. Thanks so much for watching Indian Open.